Welcome to Financial Fluency. This curriculum covers the fundamentals of business finance that are invaluable for success in the workplace. Financial fluency will hopefully help you more effectively integrate business finance within your daily professional workplace. After all, finance isn't just about money, it's all about you. So let's get started. As an overview, finance is really about making effective decisions. Managers have to make decisions, and these decisions can help advance an organization towards its overall goals and objectives. But to make effective decisions, we need something by which to measure their impact. Financial results are a common metric for a decision's success. But finance is also about communication. Organizations have different interested parties, such as owners, managers, investors, employees, and customers, just to name a few. Finance acts as a common language in which these parties can discuss their values and their goals. Finally, finance is also about turning ideas into reality. Finance is a system that is designed to help allocate the necessary resources to those ideas to help bring those ideas to reality. Okay, now it's time to talk about the overall program overview. By reviewing this program, we're confident that you'll be able to accomplish the following. You'll be able to base your everyday managerial decision-making on financial criteria. You'll also be able to advocate for your business ideas with senior management. Finally, you'll be able to translate your company's strategic goals and financial metrics into terms that are meaningful to your teams. Overall, we're confident this program will be able to demystify finance and make it useful in your daily work life. So let's move right along here and get to the good stuff. Alright, it's now time to talk about the basics of business finance. So let's quickly go through a review here. First of all, a company wants to buy low, and then it wants to sell high. This is the most basic principle of business finance, and this is achieved by selling goods or services at a higher price than the cost to produce or to acquire them. When a company sells something, well, it's going to bring in some revenue. And when a company buys the resources needed to make or to sell that something, it's going to incur a cost. The difference between these two, that's called the profit. And when its revenue is greater than its costs, well, it makes a profit. But when its costs are greater than its revenue, that's a loss. Now let's take a look at an example here. Okay, let's say you're the CEO of a candy company.
Yummy.
And let's say you sell $1,000 worth of candy. Well, that's $1,000 in revenue. But in doing so, you incur $500 in costs to make and to deliver that candy. Well, that's $1,000 in revenue. Subtract $500 in costs. Well, what do you get? You have $500 in pure yummy profits. Okay, Brainiac, we're going to turn up the heat a little bit. In terms of costs or expenses, there are two primary types. There's variable costs and there's fixed costs. In general, variable costs are those that depend on the volume of units sold, such as ingredients or materials. In this case, ingredients are chocolate, nougat, peanuts, what have you, wrappers, trays the candy bars sit in. In terms of fixed costs, these are costs that a company incur no matter how many units they sell. A couple examples here is real estate, equipment, utilities, what have you. Now, there are other types of corporate expenses, but for now, this will probably do. All right, we're going to start putting all this together now.
Let's see it.
A company's revenue is usually found by multiplying the number of units that it sells by the prices that it charges. Revenue is a company's income before its costs are deducted. From there, the costs are calculated. In this case, fixed costs plus variable costs equals total cost, and that's deducted from the revenue. This hopefully gives us profits. Revenue minus total costs equals net profits. At least hopefully it's profitable. Okay, it's time for an example. Here we go. Remember, you're in charge of that yummy candy company.
Yummy.
So let's assume the following. Assume that each candy bar costs $1. You sell 1,000 units. It costs 5 cents to make each one of those candy bars, and your total fixed costs, well, that comes to $500. Okay, so since you're selling these things for $1, and let's say you sell 1,000 of them, well, it's 1,000 times $1 is $1,000 in revenue. And remember, each one costs 5 cents to make, so that's 5 cents times 1,000 is $50 in variable costs, plus your $500 in fixed costs. So that means it's 1,000 minus 550 in total costs. Well, that comes out to $450 in profits. Sweet! $450 in profits? Wow, I'm pretty good at being CEO. So let's step right along here. We're now going to talk about something called the break-even principle.
Say what?
A common question in running a business is, how many of these things do I need to sell to actually break even? Well, that's a common question. It's pretty easy to answer. First of all, there's a couple things that you need to know. You need to know your fixed costs, your variable costs, and your price. So then, from there, the break-even principle is simple. It's just the fixed costs divided by the unit price minus the unit costs. That's not too bad. That's really just some basic simple division. But let's take a look at an example now. Okay, we're going to assume the following. A candy bar still costs just $1.
Yummy.
The variable costs are still just 5 cents per unit. But in this case, the fixed costs are now $50,000 per year.
Uh-oh.
So, to calculate the break-even point is not that bad. You just simply take $50,000 over 1, which is the price, minus 5 cents per unit. You do the math, and that comes out to $52,632. So, what does all this mean? Well, that's pretty simple. That means you need to sell 52,632 units to break even. Any more units would be profitable, any less, you'd be losing some money.
Uh-oh.
Now it's time to look at the financial statements that companies use to report on their financial performance. These statements usually give us a more clear picture of a company's overall financial health. So let's dive in. Financial Statement Introduction. Previously, we learned the most basic formula that drives business performance is revenue minus costs equals profit. A company that has more revenue than costs, well, they should be profitable, right?
Yup.
Well, unfortunately, this isn't always the case.
Uh-oh.
Why, you ask? That's because it depends on how a company reports their financial results. This leads us to the two types of accounting. There's cash-based accounting, and then there's accrual-based accounting. So let's explain this in a little more detail. The two types of accounting. First of all, there's cash-based accounting. This is when sales are recorded when the money is actually received, and expenses are recorded when they're actually paid out. The advantages to cash accounting are twofold. First of all, it's very simple to manage. Secondly, because of its simplicity, it's very inexpensive to manage. Now, accrual-based accounting. This is when sales are recorded when the sales actually occur. It doesn't matter when the money is received, and expenses are recorded when they're recognized. This is often preferred because it helps create a more clear picture of the overall financial health of a company. Okay, now that you understand the two types, let's take a look at an income statement. All right, here's an example income statement. Now remember, profits equal revenue minus the expenses. So let's take this apart. And remember, revenue equals units times the price. So this is your first cost, the cost of goods sold, which is a variable cost because this depends on how many units are sold. Now comes your fixed costs. These are costs that a company incurs no matter how many units are sold. Put these costs together and you have the total costs. And subtract total costs from revenue and you have $24,000 in profit. Oh boy, on to the balance sheet. The balance sheet is controlled by this equation. Assets equals liabilities plus shareholders' equity. That's the key to the balance sheet. The balance sheet looks at the assets the company owns, what it owes, and what its owners own at a single point in time, which is usually the end of the year or a quarter. Assets and liabilities are grouped as short-term, called current, and long-term. Current assets are things that can easily be converted into cash. Cash is a current assets, as are accounts receivable and the inventory of a company's unsold goods. Long-term assets are things the company owns that the company will have a difficult time converting into cash within the next year. This is things like factory, property on which it sits, and so forth. Liabilities are debts owed that are due for repayment within the next year. They can include anything from credit card charges to the next payroll. Finally, owner's equity. This represents the remaining interest in an asset of a company spread among individual shareholders in the form usually of stock. Let's take a look at an example. Now remember, the liabilities plus equity must equal the assets. This is why it's called the balance sheet. Now here's an example balance sheet to take a look at. Let's now look at the assets side of the balance sheet. On the asset side, we have cash, we have receivables, and we have tools. All that totaled equals $37,800. This is the asset side of the balance sheet. Moving to the other side of the balance sheet, let's take a look at liability and owner's equity. In this case, liabilities notes due of $30,000. In this case, that's the only real liability. So the total liabilities so far for this period of time is $30,000. Now the owner's equity, capital of $7,000, retained earnings of $800, owner's equity totaled of $7,800. Add the owner's equity and the liabilities gives you $37,800, which balances out to the asset side of $37,800. Hey, not too bad. What do you know? We actually came out with a balanced balance sheet. So let's move on. Our third financial statement is the cash flow statement. This shines a spotlight on potential discrepancies and helps resolve them. A bank account statement is similar to a statement of cash flow. The goal of the cash flow statement is to start with a company's cash balance at the beginning of a time period and show the transactions during that period, which leads to the amount of cash on hand at the end of that period. And they're broken into operations. A company's purpose is to generate cash flow from its operations, basically buying low and selling high. Investments. Companies buy and sell new fixed assets such as buildings, factories, equipment, and so on, resulting in cash in and cash out. Finance. When companies need more cash, they may generate inflows by borrowing or selling shares in the company. Conversely, companies use up cash when they repay borrowed money or distribute profits to their investors. It's much easier to understand a statement of cash flows when you just simply think of it like a company's overall bank statement. All right, so let's keep moving along here. The 40,000-foot view of financial statements. Each financial statement provides a different perspective on a company's financial performance. The income statement is the most heavily scrutinized of the three, but all three combined create a complete picture of the financial health of a company. Financial managers must pay attention to both the short and the long-term interests of the company. Only paying attention to short-term risks growth. Conversely, looking only at long-term risks overstretching resources and short-term cash flow. A balance between short and long-term financial management needs to be managed. Okay, it's time to buckle up. We're now going to look at financial analysis tools. These are the most commonly used tools and formulas to do financial analysis on projects. So here we go. We're going to start off by taking a look at the time value of money. The basic idea here is that $1 today is going to be worth more than $1 tomorrow. All you have to do in this case is just ask your grandma, and she's certain to tell you that a car only cost $100 when she was young. Much of this is due to inflation. Inflation is a trend where currency loses its value relative to society's goods. But there's another element here, and that element's called risk. Think about the stock market. Risk is the uncertainty of future events that may have a detrimental effect on value. An opportunity cost assumes that we prefer to enjoy things today rather than wait for tomorrow. But the question is, how do we take these factors into consideration when we determine the value of future cash flow?
Not sure.
We can reduce the value of future cash flows in comparison with present-day cash flows. Technically, the time value of money refers only to its opportunity cost. So let's see how we actually calculate risk. Tomorrow's cash flow is less valuable for another reason. It's risky. You never know who or what will happen to your money over time. The future is uncertain, and so are future cash flows. The more distant they are, the more risky they become. That makes them less valuable. A risky project has to either bring in great rewards or be relatively inexpensive to undertake. In this way, risk contributes to a manager's assessment of a project's value. Basically, the riskier it is, the better it should pay out over a certain amount of time. One way to measure this is something called the present value, or PV. So let's start with a question here. How do we know if $100 today is worth more than $150 tomorrow? how do we standardize on the value of future cash flows? This is where the present value comes in, or PV. Well, let's take a look here. Present value compares the value of a dollar today to the same dollar in the future, taking inflation and returns into account. If the present value of a prospective project is positive, well, it should be considered. However, if the present value is negative, the project should probably be rejected because cash flows will also be negative. If one has to choose between receiving $100 today or $100 in a year, the rational decision is to take the cash today. If the money is to be received in 1 year and assuming the savings account interest rate is 5%, the person has to be offered at least $105 in 1 year so that the two options are equal, receiving $100 today or receiving $105 in 1 year. This is because if you cash $100 today and deposit it in your savings account, you will have $105 in 1 year. Now, at this point, you're probably saying, say what? Could you repeat that again? Yeah, no problem. Let's do an example here. Okay, we're going to start this off with a question. The question is, am I better off with $100 today or $100 tomorrow? Let's see how you can mathematically solve this. What we're going to do is we're going to give you the formula and then solve it for you. Now, present value equals the future value divided by 1 plus the rate brought to the number of years. In this case, we're going to look at an example. It's 1 year, and the rate is 5%. So that means $100 over 1 plus 0.05, which is basically 1.05, equals $95. So the answer here is no. $100 tomorrow is valued at $95 today, so you'd be losing some money. So at this point, you may be asking, why does this happen? Well, remember, money loses value. Again, just ask Granny Marge. She'll tell you how much things used to cost a long time ago. Now we're going to look at cash flow analysis. And the best place to start here is with the internal rate of return. How about other ways to measure an investment? Well, the IRR, internal rate of return, is another way to measure a potential project or investment's value. The higher a project's internal rate of return, the more desirable it is to undertake the project. Think of IRR as the rate of growth a project is expected to generate. Now, NPV and IRR are actually very similar. You can use a cash flow analysis to determine either one. It's a matter of deciding which variable you wish to solve for. Now, internal rate of return does have some basic limitations. First of all, it can lead to misleading results because it ignores the size of the project. But because the financial world loves percentages, executives usually prefer internal rate of return over present value or net present value, even though PV is a better tool for measurement. Now, I understand if your brain's starting to explode here. Don't worry, because we're going to look at the example here, an example cash flow. So let's take a look. Now, how about a more simple way to decide on a project? Sure, we'll call it the payback period. The payback period is simple and best reviewed through an example. Now, let's say you're buying a new copy machine. Buying this new machine and disposing of the old one, well, that would cost you $2,000. But lower maintenance and increased productivity can lead to a net yearly cost savings of $1,200 per year. So think of it this way. The payback period is just the number of years it takes for the project's cash inflow to completely counterbalance the initial outflow. So after 2 years, this project will have delivered $2,400 of net cash inflow, more than making up for the initial outlay of $2,000. That's the payback period. Rounded up to the next even year, a good project is one that has a low payback period. Easy to understand, huh? Yeah, you can do this one on the back of a napkin, no problem. There are 2 problems though. It completely ignores the time value of money and creates the danger of being blindsided by risk. All right, the capital budgeting process. No matter how rosy it looks in terms of NPV, IRR, PV, or any other metric, a large cash-intensive project will not be approved overnight. Typically, senior managers have discretionary budgets with which they can fund projects that come into their domains. The more senior the manager, the larger the budget, but the more expensive the project, and the higher up it has to go to get approval. Thus, more red tape will be placed in its way. Extremely large projects have to have the sign-off of the company's board of directors, who may not even meet more than once a quarter. Projects of $100,000 and up will typically follow a very well-defined capital budgeting process that can be very slow, where projects bigger than $100,000 can typically take a year to a year and a half. Although these processes can be frustrating, for instance, when one of those specialized tools is about to wear out, overall, they tend to protect the company from exposure to high risk. All organizations will have their own capital budgeting process. As managers, to get a project greenlight, we have to understand this process. Presenting a business case with solid data and positive present values, or IRRs, is just the beginning. Navigating the goals of a capital budgeting involves negotiation skills, communication skills, and some good political abilities. Well, you've done it, and congratulations. You've now reached the end of this basic introduction to finance. Finance is a lot more complicated than this, but this is a good place to start. Have a great day, and thanks for joining us.